Welcome to video 4 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss deductions and credits. We have a lot of ground to cover in this one, so let's get started. Specifically, what we will study in this video are business deductions, compensation and fringe benefits, and then business tax credits. Our free resources from irs.gov, we do have quite a few this time and quite a few in bold. So you can see publication 334, which we've seen before, publication 535, business expenses. We've also seen that one. Then we've got publication 925, passive activity and at-risk rules. I recommend that one. And then publication 463, travel, gift, and car expenses. The IRS likes to test these topics, so we will be covering them in this video, of course, but you'll also want to check out the publications. And then we have these three sister publications, publications 15, 15A, and 15B. So I recommend you check those out as well. And then the others as well, if you're interested in those particular topics. Let's start our discussion in this video by talking about business deductions. In order to be tax deductible, expenses must be ordinary and necessary. So this comes from section 162. You will definitely get a question about this on the EA exam. This is a universal definition used in the tax code. You need to know it. Expenses must be ordinary and necessary. That comes from section 162. The words ordinary and necessary do not necessarily mean what you might think they mean from their common usage in the English language. So ordinary means the expense is common and accepted in the taxpayer's line of work. So that's kind of what you would expect for ordinary, but we'll talk a little bit more about that. And then necessary means the expense is helpful and appropriate for the taxpayer's trade or business. An expense does not have to be indispensable to be considered necessary. So normally when we think of the word necessary, we mean you absolutely have to have it. Like your business could not run if you did not spend this money. But that is not what necessary means. It means what it says on the screen. The expense is helpful and appropriate for the taxpayer's trade or business. So you will want to remember that. You also want to remember the definition of ordinary, but do know that when we're talking about expenses for business purposes, it says it has to be common and accepted in the taxpayer's line of work. It is possible that you have a business expense that nobody in the history of the IRS has ever had before in your line of business, and it could still be a valid business expense. So when it says it's common and accepted, that is the guideline. That's the definition you want to know for the exam. But just know that in practice, what ordinary and necessary means is that it is legitimately a business expense. There's no question. You're not stretching the definition. In your heart of hearts, you know this is a business expense. So that's what it is. Ordinary and necessary. For the exam, you want to know those definitions. Some things are not deductible. So you'll remember when we were talking about accounting and accounting methods, we said that there are book to tax differences. So these non-deductible expenses are going to account for some of those book to tax differences. So when you look at the company's financial statements, their income statement in particular shows all of their expenses on a book basis. Maybe it's according to generally accepted accounting principles. Most of those expenses will be deductible for tax purposes. However, there are some exceptions. So the number one exception that we always need to make sure that we are pointing out is that personal living and family expenses are never deductible. Now, these should not be on your GAAP financial statements either, but it's just important to know you can never deduct personal living and family expenses. Once in a while, you will see tax promoters, tax advisors going around giving seminars or talking to small business owners, and they want to try to sell them for a very high fee this special plan that is going to save them all kinds of money. And it may have to do with setting up a special kind of trust that only the wealthy people knew about, but now we're going to tell you about it. And then maybe you put your house in this trust, and then you have a business that's an LLC, and then the LLC rents the house from the trust, and then all of your family members are employees. And then all of a sudden they say, well, now you can deduct your mortgage payments and you can deduct your food that you feed your family because they're all employees, and you can deduct their clothing, and you can deduct their private school education. All of a sudden, all of your personal expenses are supposedly now tax deductible. Well, I'm here to tell you, if you ever hear anybody doing that, run away from them. That is not possible. That is a scam. Even if they tell you, look at all of these satisfied clients we have bragging about how much money they save in taxes, eventually they will get caught. People go to prison for this all of the time. Even if you don't go to prison, you'll end up paying a bunch of back taxes, penalties, and interest. It'll be very, very expensive. Personal living and family expenses, no matter how many trusts, no matter how many LLCs or corporations that they have, no matter if it's overseas or in the United States, doesn't matter. You cannot deduct these things. They are not tax deductible. So moving on. Bribes and kickbacks. The government does not want to give you an incentive to pay a bribe or a kickback, so they are not deductible. Even in some foreign countries, there are some foreign countries where it's just kind of the way it is. If you want to get anything done, you have to grease the wheels by paying the local officials some money. Doesn't matter that that's the accepted practice in that country. It is not tax deductible. Similarly, fines and penalties. You do something wrong, your business has to pay a fine or a penalty. The government doesn't want to encourage that behavior, so it is not tax deductible. Club dues. So this is one you're going to see a lot. So no club dues are deductible. Doesn't matter if it's a business club, social, sporting club, airline and hotel clubs, doesn't matter. Now, I can hear your objection now, and that is, hey, Tom, I do my best business at the country club on the golf course. That's where I sign my biggest deals. It's definitely business related. Well, sorry, doesn't matter. The IRS will not let you deduct that. Similar with the airline and hotel clubs. You might say, yeah, but when I'm traveling, I need a quiet place to make my phone calls and to do my work. That might be a great idea. You can certainly do that, but you cannot deduct the cost of those club dues. Next is entertainment is not deductible. In the past, it was. You could deduct all or part of it, but no longer can you deduct entertainment. Political contributions are not allowed, and similarly, lobbying expenses are not allowed as deductions for tax purposes. And there are other expenses that may be limited, such as meals, that we will talk about. You can generally deduct business expenses even if they exceed your income. So this creates a loss, or what's called a net operating loss, or NOL. We talked a little bit about this in part one. NOLs can be carried forward indefinitely, but they cannot be carried back, except there was a couple of exceptions to that you may remember. But in general, NOLs cannot be carried backwards, but they can be carried forward. When they're carried forward, they can only be used to offset 80% of current year income, and then whatever's left you can carry forward to the next year, and so on and so forth. It is possible, though, that you cannot deduct those losses because there are certain rules that may limit the losses. Those are the at-risk limits, the passive loss rules, and the hobby loss rules. We already discussed the hobby loss rules back in video 1 of part 2, but in this video we will talk about the at-risk limits and more about the passive loss rules. The at-risk rules limit your losses for most activities to your amount at risk in the activity. In other words, you have to have put some sort of money or property into this activity that you could lose, or you have to have amounts that you haven't put in there yet, but maybe you've used those to guarantee a loan, and you could lose those amounts if the loan is not paid back. But you have to have real money or property at risk of loss in order to deduct any losses from that activity. These rules apply to individuals, so that includes partners and S Corp shareholders who are individuals, estates, trusts, and certain closely held C corporations. What's a closely held C corporation? It is closely held if at any time during the last half of the tax year, more than 50% in value of its outstanding stock is owned directly or indirectly by 5 or fewer individuals. So if you have a closely held C Corp, they have to abide by these at-risk rules just like individuals do. If it is any other kind of C Corp, then they do not have to worry about these at-risk rules. If you do have some losses that are disallowed due to these rules, you can treat that loss as a deduction from the same activity in the next year. So if next year you've got income from that activity, or you've got more money that you put into it, so you've got more at risk, then you can take those losses at that time. If you can't do it that year, you can carry it forward to the next year and so on. If you do have losses that are allowed, they are subject to recapture in later years. So, in other words, you have a loss this year, it's allowed because you've got amounts at risk. And then later, you've got more losses, and the amount of those losses exceed the amount that you had at risk at that time. You may have to go back and then include in income the losses that you took in that previous year. So, what amounts exactly are considered to be at risk? First, the money and adjusted basis of property you contribute to the activity. That's the easiest, most straightforward. Second, amounts that you borrow for use in the activity can be considered at risk if you personally are liable for any repayment, or you pledge property as security for the loan, and it can't be property that's actually used in the activity, but maybe you put up your house as security for that loan. And that loan must not be from a person who has an interest in the activity or someone related to a person who has an interest in it. So it could be from a bank or it could be from an individual, but it has to be an individual who has nothing to do with the activity itself. In addition, qualified non-recourse financing of real estate can also be considered at risk. In order for that to qualify, it must be borrowed from a traditional lender, such as a bank, and secured by real property that is used in the activity. So, first of all, let's talk about this non-recourse. Non-recourse means the bank cannot go after the individuals who are borrowing the money. Basically, all they can do is foreclose on the property in order to get their money back. So that's what non-recourse means. But let's say you've got some partners in a partnership. They've got a building that they're using in the business. They get a non-recourse loan on that building. So if they don't pay the loan, the lender is going to come and foreclose and take that building. So since the partners are all partners in the partnership, that's their building, they're using it in the business, that is considered to be money that is at risk. Next, let's talk about passive activity losses. We did talk about this some in part 1, but we're going to go into more detail now. You cannot deduct losses from passive activities in excess of income from passive activities. What are passive activities? It is any trade or business in which you do not materially participate, or it is a rental activity, even if you do materially participate, unless you are a real estate professional. The rental activities piece we will go over later in video 8. For this video, we're just going to focus on the trade or business in which you did not materially participate. Any unused passive losses can be carried forward to future years. Now, they can only be used again to offset income from passive activities. So, passive activity losses, no matter when they were generated, can only be used to offset income from other passive activities, but you can carry them forward. And you have to apply the at-risk rules before applying the passive activity loss rules. So if you don't have amounts at risk, then you can just stop right there. You don't even have to worry about whether or not you materially participate because you can't take any loss from that activity. So what do we mean by material participation? So you materially participate in an activity for the year if any one of the following apply. So remember, passive activity losses can only offset passive activity income. So frequently, if you have a loss, you don't want it to be a passive activity. So that means you want to be found to materially participate in that activity, because if you materially participate in that trade or business, then it is not a passive activity. So you don't have to worry about these passive activity loss rules. On the other hand, let's say you do have some passive activity losses. There may be a different trade or business that you have that has income, it has a profit. You might want that activity to be a passive activity. Why? Because remember, you can only offset passive activity losses against passive activity gains, income. So if you've got a profitable business and you've got a unprofitable business that is passive, it would be nice if that profitable business were also passive. And so in that case, for that profitable business, you might want it to be a passive activity. So that means you do not want to be materially participating in that activity for the year. So it just depends on your personal situation whether or not you want a particular activity to be passive or not, and therefore whether or not you want to materially participate in that activity. In any case, this is how you determine whether or not you materially participate in an activity. If you participated in the activity for more than 500 hours during the year, then you automatically materially participated. It is not a passive activity. Or if your participation was substantially all the participation of everyone, including non-owners. So if what you did, the amount of time you spent on the activity was essentially all anybody did, there weren't any employees, or if there were any employees, they didn't do much. Anybody else who's involved in the activity didn't do much. You were pretty much it. Then it is not a passive activity. You materially participate. Or if you participated more than 100 hours, and that was at least as much as anyone else participated. So if you put in more than 100 hours and nobody put in any more than you did, even employees, then you materially participated. Or if the activity is a significant participation activity and you participated in all significant participation activities for more than 500 hours. A significant participation activity is any trade or business you participated in for more than 100 hours and did not meet any of the other tests. So let's say you've got multiple businesses that you are involved in. So you don't put all of your time into any one of those activities, but you put in more than 100 hours into each of them. So maybe you've got 3 activities, you put 150 hours into one, you put 200 hours into another, and 200 hours into the other one. So your total is 550 hours. So you've got more than 500 hours in total, and you've got more than 100 hours from any particular activity. Then you meet the test. Those are significant participation activities, and you qualify as having materially participated in each of them. Next, if you materially participated in the activity for any 5 of the preceding 10 years. So you met any of the other tests 5 of the preceding 10 years, but you didn't necessarily meet the test this year or even last year. But if you look back 10 years and you could say, yes, 5 of the preceding 10 years, I materially participated, then you will be considered to have materially participated this year. Also, if the activity is a personal service activity in which you materially participated for any 3 preceding tax years. Personal service activity, like we've seen before, this involves health, law, engineering, accounting, actuarial, performing arts, or consulting. So this is designed for retired partners. Maybe you're a retired partner in a law firm. You used to be active. You're not anymore. That will still be considered a non-passive activity for you. And then the last one is the facts and circumstances test. So if based on all the facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis, and you participated for more than 100 hours, then you can count that as being a non-passive activity. When you're counting up your 100 hours, You cannot count management hours unless no one else received compensation for management and no one else spent more hours managing it than you did. So if you've hired a professional manager, then you can't count any hours that you did managing towards your 100 hours. This is one, obviously, you are going to have to document what you did to prove to the IRS that, hey, yes, I really did materially participate in this activity. Now we're going to move on to specific types of deductions that can be taken. We will start with bad debt. You have a bad debt if you cannot collect money owed to you, but you can only deduct it if you already included the amount in income. So, for example, a cash basis business bills a client for services rendered, and the client does not pay for more than a year. Efforts to collect are unsuccessful, and the client cannot be located. Since the amount was never included in the cash basis business's income, it cannot be deducted as a bad debt. Example 2, same facts as example 1, except the business uses the accrual method, recording the income at the time of billing. The bad debt can be deducted. So either way, the business is going to end up at zero tax effect. They never included the amount in income. They never collected the amount from the customer. So there's zero tax effect. The accrual basis taxpayer included the amount in income. They get to write off the bad debt. Those cancel each other out. So there is zero tax effect. Types of business bad debts. First, you have credit sales. That's what we just talked about. So if you're an accrual basis taxpayer, as we said, you can deduct that. You could also have loans to clients and suppliers that go bad. Debts of an insolvent partner that you paid. So sometimes you got a partnership, two or more partners, and one of the partners is insolvent and they can't make good on their share of a liability from the partnership. The other partners then pitch in to pay that liability off. They can then deduct the amount they paid as a bad debt. And then finally, payments on a business loan guarantee if certain criteria are met. So if you guarantee the business loan of someone else and they can't make the payments, you end up having to make payments on their behalf, then you can also deduct that as a business bad debt. Loan or capital contribution. You cannot claim a bad debt deduction for a loan to a corporation if, based on the facts and circumstances, the loan is actually a contribution to capital. So this goes back to why it is so important that you have in place things such as loan agreements and that they have market interest rates and that they are the same type of loan agreements that you would use with someone who is not a related party. Because if you are loaning money to a corporation, then you are going to be related parties. So you want to make sure if you are doing that loan, two things. It's called substance and form. First of all, the substance of the transaction, so the actual economics of the transactions has to be, it actually was a loan. And then separately, you want to show the form. You want to have in place the contract with market rate interest. Everybody follows the terms of the contract, makes payments when they're supposed to make payments, pays the interest that they're supposed to pay, etc. So usually in the tax law, we talk about substance and form. We say that is the substance that really matters. The substance of the transaction is what's important, no matter what the form is. When you are dealing with related parties, you want both. You want to make sure the substance is actually what you are saying that it is, and you want to have the form so that if anybody looks at the paperwork, they can see that, okay, they are handling this in a business-like manner. But if you are pretending that a contribution to capital is a loan, then you cannot write off that loan. That's what this is saying. If it was a capital contribution, then it was a capital contribution, and you cannot write that off. So when do we decide that a debt has become worthless? The answer is when there is no longer any chance the amount owed will be paid, and you must make reasonable attempts to collect it. So the most straightforward one would be, let's say whoever owed you the money filed bankruptcy and you filed your claim with the bankruptcy court, and bankruptcy judge came out and said, sorry, you're too far down the list and there's no money left to pay your loan back. You're not getting anything. Well, obviously, you're not getting anything. That debt is worthless. You can take the deduction at that time. But it doesn't have to be that clear cut, that straightforward. Like the example we used earlier where the client didn't pay. Now we can't locate the client. We've been trying to find them, been trying to get the money, haven't been able to. That would count as well. You just have to show that you're not going to get paid and that you've made reasonable attempts in order to collect. When you write off bad debts, there are two ways to do so. The first one is the most common one, the one you'll deal with the most, called the specific charge-off method. So you deduct specific bad debts that become partially or wholly worthless during the year, and you must generally deduct it in the year that it becomes worthless. So this just says, okay, this customer is not paying. I'm on the accrual basis. I included it in income. They're clearly not paying. And so we are going to write that invoice off this year. That's the specific charge-off method. The other method is called the non-accrual experience method. So this is only for certain accrual basis taxpayers with an applicable financial statement. So those audited financials, they may be able to just not accrue the income from a service provided if experience shows it won't be collected. This applies to either of the following: to businesses that are in the business of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting, or any business with less than $30 million of average annual gross receipts in the last 3 years. So it is only for services. But what happens is you've got, let's say, law firms. They're doing their business. They are billing their clients. They know from experience that there's going to be a certain amount, a certain percentage that they are not going to collect. So let's say from experience, they know that 3% of all of their invoices are not going to be collected. What they can do is they can just deduct every year 3% as bad debts. Actually, what they do is they just don't count into income 3% of their revenue because they assume it is not going to be collected. So if you do the non-accrual experience method, you're just going to take that same percentage of your sales every year, and then as specific debts go bad, they just go bad, and that's just part of your doing the business. Our next possible deduction is interest. So you can deduct interest on a debt only if you meet all of the following requirements. You are legally liable on that debt. Both you and the lender intend that the debt be repaid, and you and the lender have a true debtor-creditor relationship. So these last two in particular are really aimed at these related party transactions again. If you're getting a loan from someone, from a related party, but they don't actually expect you to pay them back, there's no true debtor-creditor relationship, then any interest that you may pay or accrue, you cannot deduct. So this prevents, especially accrual basis taxpayers, from getting a quote unquote loan and then accruing interest expense and deducting the interest expense when nobody actually expects them to be paying off that loan because it's not actually a loan. Remember again, substance and form. Also, capitalized interest. If you are subject to uniform capitalization rules, remember we talked about that for inventory, you must capitalize interest as part of the inventory for any items that you produce. And you're going to see this as a recurring theme on these slides. Many of these expenses could be subject to the UNICAP rules. There's also, for interest, a limitation called a 163J limitation. This only applies to businesses with more than that $30 million in average annual gross receipts over the last 3 years. But if you are one of those businesses, there is a limit on how much interest you can deduct in any 1 year. Also, if you are a tax shelter, no matter what your size is, no matter what your gross receipts are, then this applies to you as well. The amount of interest that you can deduct is limited to the sum of these three things: your business interest income, 30% of your adjusted taxable income, and floor plan financing interest. Floor plan financing interest is something that relates to auto dealerships and similar businesses. So for the exam, just remember it is the sum of those three things: the interest income, 30% of adjusted taxable income, and the floor plan financing interest. Adjusted taxable income, there's lots of things that are adjusted. Some things are added taxable income, some things are subtracted from taxable income. You do not need to know those particulars for the exam. Just know this little formula here and understanding what 163J is and who it applies to, and you will be fine for the EA exam. Any amounts that are not deductible this year can be carried forward. You report all this on a Form 8990. And so that will show your carry forward to the following year. Taxes. You can deduct various federal, state, local, and foreign taxes that are directly attributable to your trade or business. They're usually only deductible in the year paid, even if you're on the accrual basis. So taxes are an exception to accrual. Even if you're accrual, you do not deduct them until they are actually paid. Some of the taxes are subject to uniform capitalization rules. And if you receive a refund of taxes that you previously deducted, then you must include those refunds in income. Examples of the type of deductible taxes: real estate taxes, personal property taxes, employment taxes, such as the employer's share of Social Security and Medicare, and unemployment taxes, federal and state excise taxes and fuel taxes, state and local income taxes, of course, federal income tax, not deductible for federal income tax purposes, and then franchise taxes. Sales tax is deductible as part of the item or service purchased if it is expense. So if you buy some office supplies or one of those assets that's under $2,500 and you just go ahead and deduct that, you make that election and deduct it, you just deduct the sales tax as part of that. If it is a larger item, it is capitalized as part of the cost. As you'll remember from video 3, you buy a vehicle or something for $50,000, you pay some sales tax on that. That sales tax becomes part of the basis. Of course, as we said before, if you are collecting sales tax from your customers, then you do not include the amounts that you collect in income, and you do not include the amounts that you pay over to the state as an expense. Insurance. You can generally deduct the cost of insurance related to your business. So some examples of deductible insurance are shown on the screen. I'm not going to read through all of those, but these are the normal types of insurance that you would have: property and casualty, liability insurance, malpractice, etc. Life insurance on employees is deductible unless you or your business are the beneficiary of that life insurance policy, in which case they are not deductible. Which leads us to our next slide, which is types of insurance that you generally cannot deduct. So you can see right there, life insurance, if you or your business are the beneficiary, then you cannot deduct it. Self-insurance reserve funds set up to form a reserve for possible future losses are not deductible. So what this could be, let's say that you know that you have a certain type of loss that you get every once in a while. So you want to set aside the money in order to pay that. So you can maybe set up a separate bank account, and it's a little reserve fund. So every month, a little bit of money goes into that account. And then if you have a loss, you can dip into that account in order to pay that loss. Well, that reserve funds, as you're putting that money aside every month, you cannot deduct that. Now, when you have the actual loss, then that's likely deductible, but not just from putting the money aside in order to pay possible future losses. Disability insurance that covers lost earnings is not deductible. And any insurance to secure a loan is not deductible. So sometimes, especially with small businesses, the banks will be worried that if the owner dies, then the bank's not going to get their money back if they lend them money. So they may put a clause in the loan agreement that says, in order for us to give you this loan, you have to have life insurance on the owner that is payable to the bank for as long as that loan is outstanding. Well, if they do that, that insurance is not deductible. And then here's the reminder that some insurance costs must be capitalized for those businesses who are subject to UNICAP. Rent. So, rent for business use property is deductible. If it's paid to a related party, it must be at market rates. So, here we go again with related parties. If you are renting something from a related party, that is perfectly fine. You can do it. You just want to make sure that you are doing it at market rates. You have all the agreements in place, et cetera, and so forth. For cash basis taxpayers, advance rent paid can be deducted for amounts up to 12 months in advance. Any additional is capitalized as prepaid rent and deducted the following year. We talked about this back when we were talking about accounting methods, but we used prepaid insurance as our example. But this is the same idea. Remember the 12-month rule. Even if you pay the amount now and you're a cash basis taxpayer, you can only deduct the amounts for 12 months in advance. Any amounts further out than that, you set up on your balance sheet, you capitalize it as prepaid rent, and then each year, as you pay that rent, you take the expense and you reduce that prepaid rent asset that is on your balance sheet. And rent could also be subject to UNICAP. The home office deduction, we went over this in part 1, but we are going to briefly remind you of it here in part 2. This is if you use part of your home regularly and exclusively for business. That's the phrase you want to know, regularly and exclusively. So, for example, you may have an extra room that you use to run your business. It must be your principal place of business or the only place where administrative or management activities can be performed. So, for example, a doctor might work at a hospital. That's where they actually see their patients, but the hospital doesn't provide them like an office space in order to do their billing and their other administrative type work. So they do that at home in their home office. That's fine. They can take the home office deduction. You can own your home or you can rent the home, either way, but you cannot do this as an employee. You have to be self-employed. So if that doctor is an employee of the hospital, then they cannot take a deduction for their home office expense. But if they are self-employed as a doctor, then they can do that. There are 2 methods of computing the home office deduction. First is the simplified method. So this is $5 per square foot for the area used regularly and exclusively for business with a maximum of 300 feet. So the maximum deduction, therefore, is $1,500 per year. Or you can use the regular method. Here, the deductions are based on the percentage of the home devoted to business use. Usually, this is based on the square feet used for business divided by the total square feet of living space. And in that case, you can deduct that percentage of mortgage interest or rent, insurance, utilities, repairs, maintenance, and depreciation. So this one is a little bit more of a pain than the simplified method. You got to do more work. You have to have more documentation. However, you're not limited to that $1,500 per year. So, for example, if you have a 2,000 square foot home, you use 300 square feet of that for business purposes, that's 15%. So you could then take 15% of all of those expenses as your home office deduction. The energy efficient commercial buildings deduction. So building owners who place in service energy efficient commercial building property or energy efficient building retrofit property may be able to claim a deduction for that. This deduction has been around for several years, but it was increased and expanded in 2023. So obviously in 2024, it is still there. It is available to owners of qualified commercial buildings and designers of this type of property that's installed in buildings that are owned by certain tax-exempt entities. So you do not need to know the specifics of what qualifies as EECBP or EEBRP. You just want to know about the deduction and who it's available to. And then we will also talk here briefly about computing it. The deduction is equal to the lesser of the cost of the property. So that's the first thing. So it's either the cost of the property or the savings per square foot from installing the property. So it's the lesser of those two things. I wouldn't worry too much about this calculation. Just read it through. It's 50 cents per square foot for a building with 25% energy savings. It goes up 2 cents per square foot for each percentage point of savings over 25%, up to the maximum of $1 per square foot for a building with 50% energy savings. So maybe remember the minimum and the maximum. And then also remember it is the lesser of these two things, the cost of that property or the savings per square foot. Business, travel, and meals. So we've got several slides on this. They do like to test this on the EA exam. So the first thing is business, travel, and meals must be ordinary and necessary expenses incurred while carrying on a trade or business. Now, we know from our previous slide that all business expenses have to meet this test, not just travel and meals. All business expenses must be ordinary and necessary and incurred while carrying on a trade or business. They are reminding you here that this also applies to business, travel, and meals because let's be frank, these are subject to abuse. People want to use personal meals and count those as business meals and deduct them. They want to take personal trips, family vacations, and count those as business trips and deduct them. So the IRS is reminding us that in order to be deductible, they have to be ordinary and necessary expenses incurred while carrying on a trade or business. Remember, personal expenses are never deductible. For meals, you must have receipts or records substantiating the amount, time, and place, business purpose, and identity and business relationship for meals with others. So maybe you just take the receipt from the meal, you write on there who you were meeting with and what you discussed, but you have to have some sort of documentation of all of those things. Per diem rates can be used for meals by both self-employed taxpayers and employers, but they must be the same or less than the federal rates. We're going to talk about per diem rates here in a little bit. Per diem rates for lodging can only be used by employers. Self-employed taxpayers have to use their actual lodging expenses. And except for lodging, expenses under $75 do not require a receipt. So if it's lodging, doesn't matter how much it is, you have to have a receipt. If it is a different kind of expense, if it's under $75, you do not need a receipt. However, remember, if it is a meal, you have to somehow substantiate the amount, time, place, business purpose, etc. So you will still need some sort of records for meals. For transportation expense, if no receipt is readily available, you do not need one. So if you took a taxi cab or something, paid cash, didn't get a receipt, or you took a subway, didn't get a receipt, then you can go ahead and deduct that. For an employer, these deductible expenses can be reimbursed as part of either an accountable plan or a non-accountable plan. They are deductible to the employer either way, but they are handled differently by the employee. So an accountable plan means the employee has to account for and produce receipts for expenses in order to be reimbursed. Any excess reimbursement that they may get must be returned by the employee within a reasonable amount of time. So some businesses will say, okay, you're going on a business trip. We know you're going to have some expenses, and they will actually advance you some money to help pay for those expenses. So you don't have to wait and incur the charge and then get reimbursed. Well, if they advance you more than you ended up spending, or they advance you the money and the trip gets canceled or something, then you have to pay that money back. I think that makes sense. So an accountable plan, this is your typical business reimbursement plan at a company. You work for a company, you travel, let's say, you go, you stay in a hotel, you get a rental car, you have a flight, you incur whatever other expenses, you come back from the trip, you gather all of your receipts, you turn in an expense report, and then the company pays you your money back. That is your typical accountable plan. And the employer, of course, gets to deduct those expenses, and the employee does not have to include anything in their income because they're just getting reimbursed for what they paid. So that's an accountable plan, and that is by far the most common that you will see out there. Having said that, there are some non-accountable plans. So under a non-accountable plan, the employee does not have to turn in any receipts. They are just given an amount of money and said, okay, this is to cover all of your expenses. So, for example, you have traveling salespeople. They're out in the field Monday through Friday every week calling on customers. Obviously, they're going to have expenses. They're going to have hotel stays and mileage on their car and meals, etc., and so forth. So some companies will just say, okay, rather than keeping all your receipts and turning in an expense report, we're just going to pay you, making up a number, we're just going to pay you $2,000 per month. And if you can get by on less than $2,000 a month, then good for you. You get to keep the extra. If it costs you more than $2,000 a month in order to pay all your expenses, well, sorry, that is on you. All you are getting from us is $2,000 a month. Well, in that case, the company can still deduct those amounts. However, the employee has to include it in their income. So the employer will put those amounts into wages for the employee. Meals. Meals are usually deductible if they are incurred while traveling on business or provided to a client, employee, vendor, etc. However, the deduction is limited to 50% of the cost of the meal, including tax, tip, delivery, and service charges. So you will see this frequently. This is one of the most frequent book to tax differences because obviously, for regular financial statement purposes, 100% of the cost of the meal is going to be counted as an expense. For tax purposes, you only get to deduct 50%. So you will see that difference as a book to tax difference. Now, you do see there is this one exception for employees who are in the transportation industry and they are subject to hours and service limits. 80% of their meals can be deducted rather than 50%. So that would be things like truck drivers, bus drivers, airline pilots, where they've got a limit on how much they are allowed to drive or fly during a certain amount of time. You can deduct 80% of theirs instead of 50%. Travel and lodging expenses are deductible for temporary travel away from home for business. So it has to be temporary and it has to be away from home. Now, this can also include local lodging for meetings and conferences that require the employee to be there overnight. So let's say a company is having a company-wide meeting or a sales meeting, and people are coming from all over the country to the home office location, and they're going to have their meeting there at the office or somewhere nearby. So obviously the people coming from all the other cities, their lodging and meals and everything is clearly deductible. But what about the people who actually live in that city where the meeting is being held? What about them? Well, if they are required to stay at the hotel just like everybody else, then you can go ahead and deduct the cost of that lodging. That's what this is saying. When we say you have to be away from home, home generally means your normal place of work, regardless of where the employee lives. So most people obviously do live and work in the same general metropolitan area, but that's not always the case. There are people who commute hundreds of miles from one city to the next every week. So every Sunday night or Monday morning, they take a plane or a train or they drive and they go to work and then they stay there until Friday and then they go home for the weekend and then they do it all over again. Well, if their employer is paying for their hotel room or an apartment while they're there all week, that is not deductible because that person is not away from home. Then also, deductible travel expenses include all the normal things that you would expect it to include: transportation, lodging, meals at 50%, tips, dry cleaning, laundry, etc. Per diems. So we talked about this before. Per diem means per day. So an employer who has an accountable plan can reimburse an employee for expenses based on travel days, miles, or some other fixed allowance. And there are federal mileage, meal, and travel rates that can be used in lieu of actual expenses. So in other words, they can say, instead of you giving us receipts for everything, we are just going to pay you this much per day for meals. We're going to pay you this much per day for a hotel. And if you can find a cheaper place and you can eat cheaper meals, then you get to keep the extra and it's not included in your income or anything like that. However, if you spend more, if you want to go out to a really fancy meal or stay at a really fancy place, then the difference you have to pay out of your own pocket. So the government does publish these per diem rates that can be used for this amount. So the employer cannot pay more than those federally listed per diem rates, but they can pay less. And as you'll recall, for lodging purposes, self-employed people cannot use the per diem rate. Self-employed people can use the per diem rates for meals, but not for lodging. But employers can use the per diem rates for both lodging and meals. And the business mileage rate for 2024 is 67 cents per mile. That will be tested on the EA exam. You want to commit that to memory. 67 cents per mile for 2024. Business gifts. You can deduct business gifts up to $25 per person per year. You might think that that's not very much, and you might have a point, but nonetheless, that is the rule. $25 per person per year is deductible. You can give more than that if you want to, but only $25 is going to be deductible. You do not have to count small giveaway type of items costing $4 or less as included in the $25 total. So if you're giving away like calendars or pens or something that costs $4 or less, then you don't have to include that when you're counting up your $25. Charitable contributions. Charitable contributions may be deductible by individuals, as we discussed in part one, but they are generally not allowed as a business expense, except for C corporations. C corporations may be able to deduct some charitable contributions. We will talk about that in the video on C corporations. S corps and partnerships cannot deduct them. They can still make the contributions, but they cannot deduct them. So instead, those are considered pass-through items or separately stated items. So they will report those charitable contributions on the K1 for each shareholder or partner, and then the shareholders and partners will deduct them if they are able to do so. Sole proprietors may be able to deduct charitable contributions, but they just do so on Schedule A. So it's not something they put on their Schedule C, just like any other charitable contribution that they might make. Other business expenses. So there are, of course, a lot of other expenses that we have not talked about that can be deducted. And we've listed a bunch of them here. And this is not an all-inclusive list either, but you could have advertising and training costs and cell phone costs, utilities, etc. As long as they are ordinary and necessary business expenses, then they can be deducted. Let's talk now about compensation and fringe benefits. These are, of course, deductible, but they are large enough that they are their own category that we need to discuss. Compensation. Salaries and wages, of course, that you pay to employees are generally deductible. Compensation must be reasonable, but we will discuss that more when we talk about the different types of entities, especially S Corps and C Corps is where this reasonable compensation issue frequently comes up. When employing family members, compensation must be commensurate with work performed. Now, it is perfectly fine to employ and pay family members. It's done every day all over the country. There's lots and lots of family businesses where there are family members who are employees, of course, and they are getting paid. However, as you might guess, this could be an area that is ripe for abuse. So you will sometimes have business owners who are paying exorbitant salaries to family members for doing very little work, sometimes for not doing any work at all. So you need to make sure, again, talking about related parties, that if you are employing family members, that you are paying them market rates. So how much would you have to pay somebody else to come in from the outside? You want to pay your family members about the same amount. You want to make sure that the hours that they work are documented and the tasks that are performed are documented, and you don't want to be paying exorbitant salaries to them. Pay them market rates. Fringe benefits. A fringe benefit is a form of pay for performance of services in addition to money. The general rule is that fringe benefits are taxable unless they are specifically excluded from income by the law. For most of this section of this video, we're going to be talking about those exceptions. We're going to be talking about the ones that are excluded. But you still need to remember the general rule, which is they are included in income. And the reason we're talking about the ones that are excluded is because they are exceptions to that general rule. The taxable portion of the benefit is the value of the benefit less the amount the employee paid for it. So sometimes the employee is paying something. They're just not paying the full market value. So it's the difference between that full market value and how much they paid is the taxable portion of that fringe benefit. There are special rules for some fringe benefits for partners and partnerships and greater than 2% owners of S corporations. We will talk about those in those specific videos. And also, there is a general rule of non-discrimination. So fringe benefits have to be offered to everybody. So if you're going to deduct them, they have to be offered to all employees, not just to the owners who work in the business, or not just to the upper level C-suite type of employees. So if you want to have a deductible fringe benefit, it cannot discriminate against certain employees. Cafeteria plans. So a cafeteria plan, including a flexible spending account, provides participants an opportunity to receive qualified benefits on a pre-tax basis. The employees choose from several choices of benefits and pay their share on a pre-tax basis. So what this is you'll have companies that say, we've got a whole list of different benefits that you can get. If you need health insurance, you can get health insurance. If you need dental, you can get dental. If you need a flexible spending account, you can get that. If you want life insurance, you can get that, et cetera, and so forth. And what they'll say is, we will give you X amount per paycheck to pay for these benefits. And then they show you the cost of each of these benefits. And then the employee gets to go through and say, okay, I've got this much money that they're giving me every paycheck, and I'm going to choose this benefit, this benefit. Oh, I don't want that one. Okay, I'll choose this one. Nope, not that one. I'll choose the next one. So it's like going through a cafeteria line where you're saying, yes, I'll have a little bit of that, but no, I don't want that. By the time you get to the end, then you're just paying for what you actually chose to eat. But instead of food, of course, you are choosing benefits. So that is a cafeteria plan. In order to qualify, it has to meet certain requirements, and only certain types of benefits can be part of the plan, such as a 401k plan, health insurance, HSA contributions, group life insurance, disability insurance, adoption assistance, dependent care assistance. It is interesting here that 403b plans are not offered as part of a cafeteria plan, so it is only 401k. 401k is for for-profit organizations. 403b plans is for not-for-profit or governmental type of organizations. Achievement awards. Tangible personal property given to an employee as an award for either length of service or for safety are deductible. They are also excluded from the employee's income. Now, this does not apply to cash, cash equivalents, gift cards, coupons, gift certificates, or to vacations, meals, lodging, tickets to theater or sporting events, etc. It is tangible personal property. So this is the stereotypical gold watch when you retire. Do not have to include that in income. Or it could be some award that you get for not having any workplace accidents, that kind of thing. The amount that is excludable is up to $1,600 as long as you have a qualified written plan. And large companies will have a written plan that spells all of this out. If you do not have one of those qualified plans, then the excludable amount is limited to $400. Adoption assistance. Adoption assistance provided to employees is excluded from income, but it must meet stringent non-discrimination tests so that it's not just the owners or highly compensated employees who are getting that benefit. Athletic facilities. The value of an employee's use of an on-premises gym or other athletic facility that is operated by the employer is excluded from income as long as that gym is used primarily by employees and their families. So in other words, it's not a gym that is open to the public. It's just a company gym or facility. If that's the case, then that is not included in the income of the employee. De minimis fringe benefits. Again, de minimis means small. So any de minimis benefit is excluded from income. This is any property or service that you provided to an employee that has so little value that accounting for it would be unreasonable or administratively impracticable. But it never includes cash or gift cards or gift certificates or use of a credit card. Doesn't matter what amount those things are, they are always going to be included in income. But some examples of de minimis fringe benefits that are excluded are occasional use of a copy machine for personal purposes, small holiday gifts, occasional parties that the company may throw, occasional tickets to theater or sporting events, things like that, does not have to be included in the income of the employee and can be deducted by the business. Dependent care assistance, up to $5,000 of employer-provided dependent care assistance can be excluded. That's only $2,500 if you're married filing separately. The requirements for this are basically the same as the tests that we talked about to claim the dependent care credit. Educational assistance, you can exclude up to $5,250 of educational assistance provided to an employee under an educational assistance program. The exclusion includes graduate level courses, and it includes the cost of tuition, books, equipment, fees, and supplies. However, it does not generally include the cost for any courses involving sports, games, or hobbies, unless it's related to the business or required as part of the degree program. Does not include costs for tools that the employee keeps at the end of the course, nor the costs of lodging, transportation, or meals. And the exclusion also applies to amounts to pay off the employee's student loan. So that's been added in the last few years, and that's kind of nice. So if you've got an employee with a student loan, you can pay up to $5,250 of that loan off every year without including it in their income. Employee discounts. Discounts given to employees on property or services that you offer in the ordinary course of business are excludable. So this is something that you as a business, this is what you do, and you're going to give your employees a discount. In order to qualify, the employee must perform substantial services in the line of business for which the discount is given. It does not apply to discounts on real property or investments. Excludable discounts on services are limited to 20% of the price charged to customers. So if you're a law firm and you're giving your employees free legal services, the only amount that you can exclude is 20% of what a regular client would have paid for that same work. Excludable discounts on merchandise are limited to the price charged to customers times the gross profit percentage. In other words, if you're selling something for $100 and your margin, your profit margin on that is $25, then you can only exclude $25 of that $100 item. Employee stock options. So this is section 83I. So qualified employees who are granted stock options or something called restricted stock units in a non-publicly traded company and who later receive stock upon exercise of the option or upon settlement of the RSU may elect to defer the recognition of the income for up to 5 years. So this is only particular type of options in non-publicly traded companies. So just remember, Section 83I, you've got 5 years that you can defer that income. It has to be a plan that includes not less than 80% of the employees. And this deferral only applies to the income tax, not to the Social Security, Medicare, and unemployment taxes. Employer provided cell phones. So you can exclude the cost of providing cell phones to your employees as long as there is a non-compensatory business purpose for providing the phone. In other words, you're not just giving it to them as a perk in order to attract employees or in order to say, hey, good job, we're going to give you a phone. They have to have an actual reason, business reason, that they need that phone. So some examples would include that you need to be able to contact the employee at all times for work-related emergencies. Or the employee has to be available to speak with clients at times when the employee is not at the office. Or if the employee needs to speak with clients who are located in other time zones at times outside of their normal workday. So if you have a valid business purpose for that person having the phone, then you can deduct it. You do not have to include it in their income. And personal use of that phone is also excludable as a de minimis fringe benefit. So you don't have to pretend like they're not using that phone for personal purposes. You can just go ahead and deduct it and exclude it from their income. Employer provided vehicles. If you provide an employee with a company vehicle, then you must include in the employee's income the fair market value of their personal use of that vehicle. And there's three ways to determine their personal use. You've got something called the general valuation rule, the cents per mile rule, and the lease value rule. We're going to talk about all of those. But overarching over all of this is something called the commuting rule, and that says that commuting miles are personal. So no matter which of these rules you use, your employees need to keep track of their mileage. They need to keep track of their business mileage and of their total mileage so that they can know what is their non-business mileage. When they are computing their non-business mileage, they need to include commuting miles. So their drive to the office and home from the office, those are personal miles. Those are not business miles. So you need to communicate that to your employees so that they know when they're reporting their miles the right way to do it. So now let's talk about each of these different methods of determining the amount that needs to be included in the employee's W-2 for their personal use of their company vehicle. First is the general valuation rule. Here, the fair market value of the personal use of the vehicle is the amount an employee would have to pay a third party in an arm's length transaction to lease the same or similar vehicle on the same or comparable terms in the geographic area where the employee uses the vehicle. A comparable lease term would be the amount of time the vehicle is available for the employee's use, such as a 1-year period. You determine this amount based on all the facts and circumstances. In the real world, this one is not used very much because it's pretty vague and would actually require quite an amount of work to go out and figure this out. You'd have to figure out for every employee, based on where they live, based on the type of car that they have, what would a lease cost for that? And then you'd have to come up with a lease term. Do we use 1 year? Do we use 2 year? It would be a lot of kind of subjective things and it'd be a gray area and take a lot of work and a lot of documentation. So in practice, not used very much. For the exam, you need to know that it exists and understand what it is. But now let's talk about the other rules, which are much more common. First is the cents per mile rule. Here, you multiply the employee's personal miles driven by the standard mileage rate, which is how much? 67 cents per mile in 2024. This amount includes fuel. If the employee purchases their own fuel, then you can reduce this rate by no more than 5.5 cents. So if you want, instead of making it 67 cents, if the employee has to buy their own gas, then you can reduce that by up to 5.5 cents. So that would be what? 61.5 cents per mile. You can use this rule if all of the following are true. The employer reasonably expects the vehicle to be regularly used in the trade or business throughout the calendar year. The vehicle is actually driven at least 10,000 miles during the year. It's 10,000 total, not 10,000 business miles. If you own or lease the vehicle for only part of the year, you reduce the requirement proportionally. So if you only had the vehicle for 6 months, then it would be 5,000 miles, but it's 10,000 miles on an annualized basis. And then finally, the value of the vehicle when it is first made available to the employee is no more than $62,000. So you cannot use the cents per mile method if the vehicle is worth more than $62,000. So then that brings us to the lease valuation rule. First thing to understand is, despite the name, this has nothing to do with leasing the vehicle. You don't have to lease the vehicle in order to use this method. All we're trying to determine, remember, is how much should we put into the employee's W-2 for their personal use of the vehicle. And this is just a method of determining that amount. So under this rule, you determine the value of an automobile that you provide to an employee by using the annual lease value based on its fair market value the first day it is available to the employee. The annual lease value is determined by referencing a table that's provided by the IRS, which we'll look at, and it is based on a 4-year lease term. You then multiply that annual lease value from that table by the percentage of personal miles driven based on mileage documented and reported by the employee. If the vehicle remains in service after 4 years, then you recompute the annual lease value based on the car's current fair market value. So for the first 4 years, you use the fair market value on the date that the employee started driving the vehicle. If they're still driving it 4 years later, you're going to say, okay, how much is that car worth now? You're going to go back to that table, and it's going to be worth less than it was before, and you're going to use that lower amount to determine the amount from then on. So here is the table that we are talking about. And this comes from that publication 15B that we referenced at the beginning of this video. So you can see based on the value of the car. So if you got a brand new car, it's easiest. You know how much you paid for it. So let's say you paid $35,000 for the car. So you come down here, you'd say between $34,000 and $35,999. It's $9,250. So you would take that, that's the annual lease value, you'd multiply it by the percentage of miles that are personal miles, and that would tell you the amount to include in the employee's W-2. This chart goes up only to vehicles worth $59,999. If you have a vehicle that is worth $60,000 or more, then you use this formula. So you take the fair market value of the vehicle times 25%, times 0.25, and then you add $500. So if you had an $80,000 vehicle, 25% of that is $20,000, plus you add $500. So the annual lease value would be $20,500. Then you multiply that by the personal use percentage, and that's how much you include in the employee's W-2. The amount that you determine from that table includes maintenance and insurance. But if the employer does not pay for those items, so if they make the employee pay for the maintenance and the insurance themselves, tough luck, you cannot reduce the amount that's included in the employee's paycheck. So those amounts include maintenance insurance, but you cannot take them out. On the other hand, the annual lease value does not include fuel. So if the employer pays for fuel, you have to add that. So in addition to the amount on the chart, you have to add 5.5 cents per personal mile driven for fuel. There are certain special purpose vehicles that are automatically excluded from income, so you don't have to worry about any of this. And it's because their utility for personal use is limited. So some examples of this are marked police, fire, and public safety vehicles, hearses, certain delivery trucks that you see listed here, moving vans, school buses and passenger buses, and tractors and other special purpose farm vehicles. For any of those, since they really can't easily be used off duty for personal purposes, you do not have to include any of the amounts in the employee's income. Demonstrator cars, so this is going to apply to automobile dealerships. Generally, the use of a demonstrator car by a full-time auto salesperson qualifies as a working condition fringe benefit, which means it is not included in their income. There does have to be some restrictions on personal use, and you have to meet other criteria, but mostly what you want to know for the exam is that a demonstrator car for a full-time auto salesperson is not included in their income. Group term life insurance. So the cost of up to $50,000 of group term life insurance on an employee is excludable from their income. For any amount in excess of $50,000, you determine the taxable amount by referencing some IRS tables. You don't have to know those for the exam, just know that it exists. And you have to follow the 10 employee rule, which means the benefit either is available to all employees or at least 10 employees actually have coverage. Health benefits. So the cost of employer-provided health coverage is excluded from income. Of course, this is a very common benefit that people get. This includes the health insurance itself, contributions to health savings type of accounts, COBRA premiums, health reimbursement arrangements, and other health plans. So COBRA is when you leave a job, you oftentimes are entitled to stay on the company's insurance at your own cost for a certain period of time. Typically, it is 18 months. Well, usually the employee who leaves has to just pay that themselves. However, sometimes the employer might offer to pay some or all of that for the employee who is leaving. So if they do that, the business can deduct that, of course, and they do not have to include that amount in the employee's income. This does not include the cost of long-term care insurance through a flexible spending arrangement. So it's for health insurance, not long-term care insurance. Health savings accounts, we did talk about these in part one, but just to give you a refresher, an HSA is an account an employee can use to pay for out-of-pocket medical expenses, including deductibles, co-pays, and coinsurance. Contributions by the employer are tax-free, and contributions made by the employee are done on a pre-tax basis, meaning they are also tax-free. Any withdrawals from the account are tax-free as long as they are used to pay qualified medical expenses, and any amounts that remain after the employee reaches age 65 can be treated like an IRA. The HSA, as you remember, must be combined with a high deductible health plan. The deductibles must be at least $1,500 for single coverage for just the employee, or $3,000 for family coverage, which means the employee and at least one family member. The maximum annual contributions that can be made, and this is the combination of the employer and the employee, are, and again, you saw these in part one. If it is self-only insurance under age 55, it's $4,150. Self-only age 55 or older, you add $1,000 to that. It's $5,150. For family under age 55, it's double the amount of self-coverage, so it's $8,300. And then for family coverage age 55 or older, you add $1,000, so it is $9,300. Lodging on your business premises. You can exclude the value of lodging you furnish to an employee from their wages if it meets the following tests. First, it is furnished on your business premises. Second, it is furnished for the employer's convenience. And thirdly, the employee must accept it as a condition of employment. So, for example, you've seen these self-storage lots. Sometimes they want somebody that's actually there essentially 24/7. So what they will do is they will have a little apartment above the office, and they will hire the manager, and they'll say, okay, we're going to hire you for this, but one of the requirements of the job is you have to live in that little apartment above the office. And that employee might be, okay, great. That means I don't have to rent an apartment or buy a house or anything. So that sounds good to me. And so then they live in that apartment. Well, that can be excluded from their income because they meet all of these tests. Now, the exclusion does not apply if the employee can choose additional pay instead of lodging, because if they can just choose to take money instead, then obviously it's not a requirement of the business, and so it would not be excluded. More about meals. De minimis meals. You can exclude any occasional meal you provide to an employee if it has so little value that accounting for it would be unreasonable or administratively impracticable. The exclusion applies, for example, to these: coffee, donuts, and soft drinks that the employer may provide, occasional meals or meal money provided to enable an employee to work overtime. This could apply to you if you're doing tax returns and you work for an accounting firm or a tax firm. They might say, okay, it's busy season, you're working late, we're going to buy pizza for everybody or sandwiches for everybody. They can do that, they can deduct it, and they do not have to include that in your income. And then also occasional parties or picnics for employees and their guests. So they have a family picnic day. Of course, they provide food, etc. Don't have to include that in the employee's income. This also includes meals provided in an on-premises facility if the annual revenue from the facility equals or exceeds its direct operating costs. So this is a cafeteria that is not being provided just for free meals to the employees, but you've got people coming in and paying. So I think of like a hospital where they have a cafeteria and families and other visitors will go to the cafeteria, they'll pay for their food. And then sometimes they may say to a doctor or a nurse, hey, I know we're asking you to work late, so we are going to provide you a meal in the cafeteria. That would be fine. You do not have to include that in their income. Meals on your business premises. You can exclude the value of meals you furnish to an employee from the employee's wages if they meet the following tests. They are furnished on your business premises and they are furnished for the business's convenience. And then there's something called the more than half rule. The convenience of the employer test only has to be met for more than half of the employees in order to exclude the meals for all employees. So maybe not everybody really needs to be there on the premises, but as long as more than half of them do, then they can exclude the value of these meals for everybody. And again, if the employee can choose to receive additional pay instead of the meals, then you can't exclude it, because if they could just take additional pay, then obviously it is not needed by the employer. So here's some examples of meals that you can exclude. Meals you furnish to a restaurant or other food service employee during or immediately before or after the employee's working hours. So they work there. One of the fringe benefits they get is either during their shift or right before or right after, they get a free meal. You could exclude that. Meals you furnish during working hours, so an employee will be available for emergency calls during the meal period. So again, could be a hospital saying, okay, just go down to the cafeteria and eat. If we need you, we will call you. You can exclude those. Meals you furnish during working hours if the nature of your business restricts an employee to a short meal period, such as 30 or 45 minutes, and the employee can't be expected to eat elsewhere in such a short time. In other words, they only have half an hour and they can't really run out to a restaurant, order, eat, come back in 30 minutes. So if you provide them a meal, you can exclude it. And then meals you furnish during working hours if the employee couldn't otherwise get proper meals within a reasonable period of time. So maybe you're at a remote location and there are no restaurants or anything nearby. So there's no way they could run out even in an hour, hour and a half and get a meal and be back in time. So if you provide them meals, then again, you can exclude it. Some examples of meals that cannot be excluded. So meals after work hours unless immediately after. So you've got that restaurant employee and they worked earlier in the day and then they come back in for dinner. If you provide them a meal, you would have to include it in their income. You cannot exclude it. Meals you furnish to promote goodwill, boost morale, or attract prospective employees. So in other words, there's no actual business purpose to providing the meal other than just promoting goodwill or boosting morale. Those you would have to include. Then meals furnished on non-work days or with lodging. However, if the lodging can be excluded, then so can the meals. So we talked about the rules for lodging. If you can exclude the lodging, you can exclude the meals. But if you cannot exclude the lodging, then you cannot exclude the meals. And any meals furnished on non-work days, also, you would not be able to exclude. No additional cost services. So, a service you provide to an employee, if it doesn't cause you to incur any substantial additional costs, can be excluded from the employee's income. The service must be offered to customers in the ordinary course of the line of business in which the employee works. No additional cost services are excess capacity services, such as airline, bus, or train tickets, hotel rooms, or telephone services provided free or at a reduced price. So you probably are familiar that airline employees, such as flight attendants, pilots, etc., they can fly for free on their days off. They usually go standby, so they wait and see. And as long as there is an empty seat on the plane, they can jump on that plane and they can travel for personal purposes. That's what we're talking about here. You do not have to include that in their income because that plane was going to leave. It was going to have an empty seat anyway. So there's no substantial cost increase to the airline in order to let that person get on that flight and go. Same way with hotel rooms. You got an extra hotel room anyway. It's not like you are going to rent that room out. Otherwise, it's vacant. So you let an employee stay there. Again, you do not have to include that in their income. Retirement plan contributions. Retirement plan contributions are generally deductible and not included in the employee's income. We talked about that somewhat in part 1, and we are going to go over it again in a later video in this part. Retirement planning services. So, retirement planning advice or information that you provide to your employee or their spouse may be excluded if you maintain a qualified retirement plan. So, this is where you've got, say, a 401k plan. And as part of that, the company that administers the plan offers financial planning to the participants. You do not have to include that. However, the exclusion does not apply to services for tax preparation, accounting, legal, or brokerage services. Transportation or commuting benefits, so de minimis transportation benefits, you can exclude the value of any de minimis transportation benefit you provide an employee. So, for example, occasional local transportation fare you give an employee because they are working overtime. Local transportation fare provided on a regular or routine basis does not qualify for this exclusion. So, this is, hey, you had to work late tonight. Maybe you missed your normal train or bus. So here we're going to provide you a cab or an Uber in order to get home. You do not have to include that in their income. And up to $21 per month may be excluded for public transit passes, token, or fare cards that you provide at a discount or the reimbursement for same. So you can give up to $21 per month of either free or discounted transit type of passes without including it in the employee's income. Qualified transportation benefits may also be excluded, and it includes the following: a ride in a commuter highway vehicle, such as a van, between the employee's home and workplace, a transit pass, and qualified parking. The maximum combined exclusion for the commuter highway vehicle and transit pass benefit is $315 per month, and the maximum exclusion for parking is also $315 per month. So, again, you will want to remember that $315 per month number. Tuition reduction. An educational organization can exclude the value of a qualified tuition reduction that it provides to an employee from their wages. So, this is for the education of the employee themselves or their spouse or their dependent children. Undergraduate education qualifies for the exclusion as long as it is for a current employee or their family, a retired or disabled former employee, or the widow or widower of either of the above. Graduate education qualifies only if it is for a graduate student who performs teaching or research activities for the institution. So, this is a nice perk that some colleges and universities get. You work there, you, or maybe more importantly, your children can go to that school for free or at a reduced price. Sometimes they can even go to a different school and they will cover the cost as well. Either way, it is excluded from the employee's income. Working condition benefits. This exclusion applies to property and services you provide to an employee so they can perform their job. So examples include use of a car for business, a cell phone, and job-related education. It also applies to expense reimbursements. So it's a lot of the things we've already talked about, but it also includes the business use of those. So this is the rule that allows for that exclusion. It applies to the extent that the cost of the property or services would be allowable as a business expense to the employee if they had paid for it. But the employee, of course, must account for the business use and meet any substantiation requirements for the expense. So this is just the overall rule that allows all of these expenses, all of these fringe benefits that the employee is getting to be deductible. Moving on to business tax credits. We have something called the general business credit. The general business credit for the year consists of your carry forwards of business credits from prior years, plus the total of your current year business credits. And it consists of many different credits. We're about to look at a list of them here in a little bit. It combines them into one on this Form 3800. So, in addition, you're going to have to fill out a form for each individual credit. So you got all these individual credits that make up the general business credit. So any of them that you have, you fill out the form specific to that credit, and then you consolidate them all up on this Form 3800. The credit is not refundable, but we will see in a minute that you can carry it forward. But it is not refundable, and it is limited to the greater of your tentative minimum tax or 25% of the amount by which your regular tax liability exceeds $25,000. If you're married filing separately, that's $12,500, and only if you both qualify for the credit. So the amount of the credit is limited to the greater of those two things. Any excess credits, again, not refundable, they can be carried back 1 year and forward 20 years. They are treated as used on a first in, first out, or FIFO basis by offsetting the earliest earned credits first. Therefore, the order in which they are used is carry forwards to this year, the earliest ones first, then credits earned this year, and then carry backs to this year from a future year. Plus, the credits themselves are going to be used in a particular order, which is shown on this list. So this list comes from the Form 3800 instructions. So you can see there's a long list of these different credits. And this is the order in which you would take them. If you have multiple credits, then you take them, whichever one is first on this list, you would take before you apply the next credit, and so on and so forth. We are going to talk only about a few of these that are likely to be tested on the exam, but you can look over this list on your own. The disabled excess credit. So eligible small businesses can claim a credit for expenses to make the business accessible to people with disabilities. The credit equals 50% of the eligible expenses up to a maximum of $5,000. If that credit is claimed, you cannot also claim those expenses as a deduction. And that is a common theme when we're talking about tax credits. If you are using certain costs for a credit, you cannot also take a deduction for those costs. You need to do one or the other, but not both. So that is applicable to this disabled access credit, of course, just like it is to the rest of them. So what you will want to remember for the exam is 50% of eligible expenses up to a maximum credit of $5,000. Credit for increasing research activities. This is also known as the Research and Development, or R&D credit, or the Research and Experimentation, or R&E credit. It's reported on Form 6765. There is also a Research and Experimentation deduction that you can take, and those expenses can be amortized over 5 years. So they are the same types of expenditures, but again, you can't use the same exact expenses for both the deduction and the credit. This credit is allowed for qualified research, meaning it qualifies under Section 174. It must be undertaken for discovering information that is technological in nature, and its application must be intended for use in developing a new or improved business component of the taxpayer. And substantially all of the research must be elements of a process of experimentation relating to a new or improved function, performance, reliability, or quality. So they are trying to spark innovation here. They're trying to give businesses an incentive to invent new technology. That's what this is aimed at. So the credit is generally not going to be allowed for the following things: research conducted after the beginning of commercial production. So if you've already started producing it, then it is not producing something new. So you cannot use those costs for this credit. Of course, you can still deduct them, but not get the credit. Research adapting an existing product or process to a particular customer's need. You cannot use the credit for that. Duplication of an existing product or process. So again, they're trying to get people to invent new things, not to just copy some other technology that already exists. Surveys or studies. So you might go out and say, well, we're going to do a survey of the marketplace to see what people might like to see. We want to see what kinds of products do they want, so then we can try to invent those. Well, that might be a great thing to do. However, you cannot use those costs in order to take this credit. Research relating to certain internal use computer software. So again, this is intended to develop things to bring to the marketplace to your customers. So you can't use it for internal use type of purposes. Research conducted outside the United States, Puerto Rico, or a U.S. territory. So it is only for domestic research that you can take the credit. Research in the social sciences, art, or humanities. Again, it has to be technology. And research funded by another person or governmental entity. So if somebody else is paying for the research, then you cannot take a credit for it. Qualified small businesses who are doing this sort of research. So this is aimed at startup type of companies. So instead of an income tax credit, a qualified small business can elect to use up to $500,000 of the credit against the employer's share of Social Security taxes. So when you have a startup, they are very often losing money. They may not even have a product to sell yet, so they have zero revenue. So an income tax credit doesn't really do them much good because they're not paying any income tax. So what they're saying here is they will allow up to $500,000 of it to be used against the employer's share of Social Security taxes. You know, they have to pay that 6.2% of everybody's salary for Social Security, so they can use it to offset that. A qualified small business is a corporation or partnership with gross receipts of less than $5 million for the tax year and no gross receipts for any tax year before the 5 tax year period ending with the tax year. So again, it is for newer companies. They're looking at startup companies. So if you're more than 5 years old and you had revenue more than 5 years ago, then you are not going to qualify for this. And if you had gross receipts this year of $5 million or more, then you are not going to qualify for this. But of course, you still could qualify for the income tax credit. Small business healthcare tax credit is our next credit. So this is a credit for small employers who provide health insurance to their employees. To qualify, the employers must have fewer than 25 full-time equivalent employees, pay average wages of less than $65,000 per full-time employee, offer health insurance through a small business health options program marketplace. So this is part of that ACA, Obamacare marketplace, except it is for employers. So they have to purchase the plan through that marketplace. And the employer has to pay at least 50% of the cost of the employee-only health care coverage for each employee. They don't have to pay any of the family coverage, but they have to pay at least 50% of the cost for the employee themselves. The maximum amount of the credit is 50% of the premiums paid for small business employers and 35% of the premiums paid for small tax-exempt employers. The credit is available for 2 consecutive years, but only for 2 years, beginning with the first year the employer offers the plans. The amount of the credit works on a sliding scale. The smaller the employer, the bigger the credit, and the credit is refundable. So that's why tax-exempt employers can use this. Tax-exempt employers, of course, aren't paying income tax, but the credit is refundable. So therefore, even a tax-exempt employer can use it, although the amount of the credit cannot exceed certain payroll taxes that the employer owes. So it is an income tax credit. However, it will be limited by the amount of payroll taxes that employer pays. And then finally is the foreign tax credit. We did talk about this in part 1, but just to recap again, if you pay income tax to a foreign country, you can get a credit against your U.S. taxes. It can be on either earned or unearned income. You report it on Form 1116. If it is all passive or investment type of income, you usually don't need to file the Form 1116. Any excess foreign tax credit can be carried back 1 year or carried forward 10 years, and you can choose to deduct it instead if you want. However, as we have said before, a credit is almost always going to be better than a deduction. So usually you are going to take the credit. And that is the end of video 4 and our discussion of business deductions and credits. In our next video, we will start our discussion of the specific entity types, beginning with sole proprietorships and partnerships. So I will see you in video 5.